Most people think banks simply store your money safely, but that's not what actually happens. In reality, what banks do with your money is so unexpected that once you understand it, you will see the entire financial system differently. Because banks do not just hold your deposits, they multiply them. They create money that didn't exist a moment earlier, legally and on a massive scale. In this video, I will show you exactly how banks do it, step by step, with simple examples anyone can understand. Most people have a very simple picture in their minds when they think about banks. You walk in, deposit your money, and the bank puts it somewhere safe. Maybe in a vault, maybe in a secure back room, and it just sits there until you need it again. In fact, you stop random people on the street and ask, where do you think your money goes after you deposit it? Most of them would give you the same answer. It stays in the bank, as long as it's in my account, it's just sitting there, or the bank holds it until I take it out. That's the mental picture most of us grow up with. A giant vault full of neatly stacked bills, protected by security guards, cameras, alarms, and thick steel doors. You give the bank your money and they keep it safe. Simple, safe, straightforward. And it makes sense why people believe it. Your banking app shows your balance, ATMs let you withdraw cash whenever you want, your debit card works instantly, so it feels like the bank is just storing your money somewhere with your name on it. But in reality, it's the opposite. What does the bank actually do with your money? The bank does not take your money and keep it. The bank takes your money and uses it. Legally, the moment you deposit money, it stops being your money. It becomes the bank's money. And in return, the banks give you a promise, a digital IOU, saying you can withdraw that amount whenever you want. This is the key idea most people don't know. Your deposit is a liability for the bank, not stored cash. For instance, you deposit $100. The bank does not keep it full $100 in the vault. They keep only a small fraction, just enough to give people cash when they come in for withdrawals. The rest, the bank immediately takes that money and loans it out to someone else. Your $100 might become part of someone's car loan, part of a business loan, part of a mortgage, part of a credit line. And that loaned out money still shows up in your account as if it's sitting safely waiting for you. You can withdraw it anytime, but the exact same moment, someone else is using that same money for their loan. So on paper, it looks like your $100 is still there. In reality, it's already out the door, working inside the economy. Once their first loan goes out into the world, this is where the system starts multiplying money. Let's continue with the same example. You deposited $100 and the bank loaned out 90 of it. Now imagine the person using the 90 uses it to buy something, maybe a grocery, a repair, or a service. The business that receives the $90 does not keep it as a cash. They deposit it into their bank. Now that $90 becomes a brand new deposit. And just like before, the second bank keeps only a small fraction of it, let's say $9, and then loans out the remaining $81. That $81 eventually gets spent somewhere else and ends up into another bank. The bank keeps a small portion and loans out the rest again. This cycle repeats over and over. Each time, a small amount stays in the system and the majority gets loaned out to someone new. So your original $100 deposit triggers a chain reaction. $100, then 90, then 81, then 72, then 65, and so on. Each step creates a new deposit and a new loan, all built from the same initial money. If you add up this whole chain, your single $100 can turn into around $900 of the total money circulating in the banking system. And that's the key idea. Banks are not just moving around through this repeating cycle, they are creating new money that didn't exist before. Not physically, but electronically in the form of deposits and loans. But the system goes even further than that. Most people think banks can only lend money after someone deposits it. But in modern banking, that's not actually how it works. Banks don't sit and wait for deposit before they approve loans. In many situations, the bank creates the loan first and the deposit appears afterward. When a bank issues a loan, it simply adds a new balance to the borrower's account. That money does not come from somebody else's savings and it does not come from a vault. It's created instantly with a few keystrokes. Only after the loan is created does the bank make sure it has enough reserves to meet regulations. And here's the part almost nobody realizes. When the borrower pays back the loan, that money disappears from the system. Created during lending, erased during repayment. The only part that stays is the interest in the bank collects as a profit. So the real secret isn't just the bank multiply deposits, it's that bank lending itself is the source of most new money in the economy. Deposits don't enable lending, lending creates deposits. That's the mechanism that gives banks their real power. Now the obvious question is, why would any system allow this? Why let banks create money with a few keystrokes and wipe it out again when loans are repaid? The answer is simple. Without this system, the modern economy would not function. If banks could only lend out the exact cash they physically had, loans would be almost impossible to get. Most people would not be able to buy homes. Businesses would not have the money to grow, governments could not finance infrastructures, and the economy would move extremely slowly. The entire point of this system is to expand credit, to make money available when people and businesses need it, not just when someone else decides to save it. It keeps money flowing, spending active, and the economy growing. There's another reason this structure exists. Economic confidence depends on liquidity. People need to believe they can access money whenever they want. Banks need to provide the access even while the money is being used elsewhere. Fractional lending allows the balance to exist, and behind all of this sits the central bank. Its job is to make sure the banking system always has enough reserves to function. If reserves run low, the central bank steps in. If the economy slows down, the central bank adjusts interest rates to encourage more or less lending. It's a controlled system, not chaotic, even if it feels strange at first. So while the idea of banks creating money sounds wild, the system is designed this way on purpose. It is what keeps modern economies running at the pace we are used to. Once you understand how banks create money through lending, the next question is, how do they actually profit from all of this? The answer is straightforward: interest. When a bank creates a loan, the money they issue didn't cost them anything to produce. But the moment the loan goes out, the bank starts earning interest on it. Every mortgage payment, every car payment, every credit card. Balance creates income for the bank. And because the loan money was created by them digitally, almost all of that interest becomes profit. Meanwhile, the money you deposit in your account pays you almost nothing. Banks might offer 0.5% or maybe a little more depending on the account. But the loans they issue can earn them 5, 10, even 20%. That gap, the difference between what they pay you and what they earn on loans, is one of their biggest sources of revenue. This is also why banks actively want you deposits. Deposits give them the raw material they need to issue more loans. And it's why banks consistently push mortgages, business loans, credit cards, and personal loans. These products generate interest income, which is the core of the business model. In simple terms, banks profit by charging more interest on the money they create than they pay out on the money they hold. For all its advantages, the system also comes with risks. And they are the reason banks do not have unlimited power to lend. The first major risk is bank runs. Because banks loan out most of the money they receive, they don't have enough cash on hand if too many people try to withdraw at the same time. If confidence falls, even a healthy bank can collapse simply because everyone demands their money back at once. Another risk is overlending. If banks lend too aggressively, too much money enters the economy too quickly, which can fuel bubbles like overpriced housing or rapidly rising stock markets. When those bubbles burst, borrowers default and banks absorb massive losses. There's also the risk of bad loans. Remember, banks create money when they lend, but if the borrower cannot pay it back, the loan disappears and the bank has to eat the loss. Enough bad loans can make a bank insolvent. Finally, this system makes the economy extremely sensitive to interest rates. A small rate change can slow down borrowing dramatically or push it too fast, affecting jobs, housing, business growth, and inflation. So even though the system works, it depends heavily on confidence, regulation, and careful control, which is why central banks watch it consistently. With all those risks, it's fair to wonder why the entire system does not collapse more often. The reason is that the system is built around stability, not luck. First, banks are required to follow strict capital and reserve rules. They can't lend endlessly. They must hold enough capital to absorb losses and enough reserves to process withdrawals. These rules limit how far money creation can go. Second, banks consistently monitor each other. They borrow and lend reserves between themselves every single day to make sure no bank runs short. This interbank network acts like a safety net that keeps the system functioning smoothly. Third, central banks are always standing behind the entire system. If banks run low on reserves, the central bank can supply them. If the economy slows, the central bank can lower interest rates to encourage lending. If things run too hot, it can raise rates to cool them down. These tools help prevent the system from going off the rails. And most importantly, the system works because people trust it. As long as depositors believe they can access their money and borrowers believe they can get loans, the cycle continues without interruption. So even though the mechanics of money creation seems strange, the structure around it is designed to keep everything running in a controlled, predictable way. So what does all of this mean for you personally? First, it explains why saving alone is not enough. When banks create money through lending, the total amount of money in the system keeps rising. That growth slowly pushes prices up over time, which is why inflation exists. If your money is not growing, it's falling behind. It also explains why borrowing feels easy but ends up being expensive. The system is designed to make credit widely available, but banks earn their profits from interest. That's why loans, credit cards, and mortgages come with long-term costs that add up quickly. Most importantly, understanding how money is created helps you grow wealth more intentionally. You start to see why investing matters, why debt can be useful when handled correctly, and why your financial decisions matter more than you think in a system built on credit. Once you understand how the system works, you are no longer just part of it, you can actually use it to your advantage. If you want to go one level deeper, watch my video on how credit scores really work.